Today, the Bank of Canada announced that it will be increasing its benchmark interest rate for the first time since 2018. If you have a mortgage or a line of credit in Canada, you'll definitely want to stay tuned to see what this means for you. Hey, I'm Jarek Piwowarczyk, a mortgage broker in Ontario, and welcome to my channel where I demystify the mortgage process, talk about home buying strategy, and help you build some generational wealth through real estate. If you're new to my channel, please consider subscribing and hit that little bell notification icon to be notified of future episodes. And please do me a favor, hit that like button for the YouTube algorithm so that this video can continue to help others on their own home buying journey. The Bank of Canada increased their overnight rate by 25 basis points, which is 0.25%. The overnight rate is the interest rate at which major financial institutions borrow and lend one-day or overnight funds amongst themselves. Now, it's also a tool that the Bank of Canada uses to implement its monetary policy, and in this case, it's being used to help curb the inflation. The outgoing overnight rate of 0.25% has remained unchanged since March 27, 2020, and that was after a pretty aggressive 1.5% drop compared to January 22nd of the same year, and that was again due to COVID-19. This is the first time that we've seen a rate increase since 2018. With this increase, let's break it all down and see how it will affect your mortgage rate and what you can expect to pay. For those of you in a fixed mortgage, there'll be no immediate change to your payments. That is until your maturity date, which is when you would normally renew your mortgage. The benefit of that fixed rate mortgage is that the interest rate you sign on for at the start of your mortgage is going to be the same rate that you pay for the term of your mortgage. If you're close to renewal or consider breaking your mortgage because you might want to sell or refinance, and you're going to sign up for a new fixed mortgage if that's the route that you want to choose, then your new rates for that fixed mortgage are probably going to be different than your previous rate. Fixed interest rates are guided by the Canadian bond market and won't really see a change directly due to today's announcement. So in summary, if you're in a fixed rate, this announcement's not really going to affect you whatsoever. If you're not in a fixed mortgage, then you're probably going to be in either a variable or an adjustable mortgage. There's a little bit of a difference between them, and we'll talk about them a little bit more as we go along. For both of these mortgage types, the interest rate you're going to pay is based on the lender's prime rate minus any kind of discounts that you've received. So the prime rate is the rate that the financial institutions and lenders use to base their interest rates on the money that they lend to you, their clients. So for example, yesterday's prime rate for most lenders was 2.45%. And if you received a 1% discount, your interest rate would be 1.45%. Now, with this increase in the benchmark rate, this makes it more costly for banks and lenders to borrow money from each other. And since they're in the business of making money, they're definitely going to pass on these costs to you in the form of increasing their prime rate. Think of it as a little bit of a domino effect. As the benchmark overnight rate increases, this means higher prime rates. As higher prime rates result in higher variable rates, that just means that there's going to be increased costs in some debts. Not all of them, like we saw with the fixed, but some debts that rely on this prime rate. With an increase in the overnight rate of 0.25%, the new overnight rate will be 0.5%. And most lenders will follow suit to increase their prime rates in the same amount to a new prime rate of 2.70%. Although this is the case, you will maintain that original discount of, again, for example, prime minus 1%, as that's the rate that you contracted when you first signed on to your mortgage. So with this new prime rate at 2.70%, you'll still pay that prime minus 1%, which is now going to be equal to 1.7% interest. So looking at rates is one thing, but let's put these into actual numbers. Let's say you had a mortgage of $500,000 in a 5-year adjustable rate with a 25-year amortization. So that's the total life of your mortgage. Let's say this is compounded monthly. The rate discount you locked in was prime minus 1%. So with prime being at 2.45% previously, you'd be paying 1.45% in interest. Now, for this loan taken together, you'd expect to do a monthly mortgage payment of $1,988. Fast forward to today with a 0.25% increase in the overnight rate, as well as the prime rate, your prime rate would increase to 2.70%. And with your, again, discount of prime minus 1, your new interest rate would be that 1.70%. For that same $500,000 over 25 years, your new payment with the new prime rate would be $2,047 per month. And this equals a $59 increase in your payment per month. So let's assume you just sign on for this mortgage and you have your full 5-year term ahead of you. This would cause you to pay $5,830 more in interest with this new prime versus the old prime. Now, let's say, for example, your mortgage is not $500,000. Maybe it's $1 million mortgage. So how much of a difference would you expect? Because it's double the mortgage, you basically double the difference in the monthly payment. So you'd expect about $118 more per month for that $1 million mortgage. Now, hindsight is always 20/20, and you could have been like, I shoulda, coulda, woulda. So if instead you decided to go with a fixed mortgage at, let's say, 2.9% instead of that adjustable for that $500,000 mortgage, your payment would be $2,341 a month. That's $353 more than the original adjustable rate mortgage. And what's worse, you're going to be paying $33,768 more in interest over that same 5-year term. Now, you might hear adjustable mortgage and variable rate used pretty much interchangeably, but they are a little bit different. Both base their interest rate on the lender's prime rate, but what you might experience after this overnight rate may differ. So the scenario we just spoke about is one of an adjustable rate mortgage, where as the rate changes, your payment also changes. Your payment increases because you have to pay the extra interest that you're being charged, while also ensuring that you're paying down some of your original principal that you took out. So that's that $500,000 in this case. So you're mostly going to be with an adjustable rate mortgage if you have your mortgage with a mortgage finance company like First National, MCAP, Merix, Lendwise, RMG, RFA, some credit unions, as well as banks like Scotiabank and National Bank. And importantly, if you're an adjustable rate mortgage, do me a favor and smash that like button. Now, what about variable rate mortgages? So variable rate mortgages are mortgages where as the rate changes, your payment doesn't change to a certain point. With a variable rate mortgage, as the interest amount increases due to that higher rate, more of your payment is actually going to be going into paying that higher amount of interest, and therefore less of it is going to be going into paying your original principal. Again, that $500,000. So what can happen is that this may lead to a longer amortization. I mean, it's going to take longer for you to pay off your mortgage. This is not a favorable situation with the lender. So they might actually just call you up and say, hey, we need to figure out a solution here. So to keep your amortization in check, your lender might require you to make maybe a lump sum payment. They might negotiate your payments to a new higher static payment amount. So again, it's not going to change from that new one, but it's going to be higher than your original amounts. Or they might just simply leave it, causing you to have a higher balance at the end of your 5-year term than you originally planned. So how do you know if you're in a variable rate? You're probably going to be in one if you have a mortgage with a lender like TD, HSBC, RBC, CIBC, or BMO. For individuals in this product, you might not expect your payment to change with this announcement, but you definitely want to consult with your mortgage broker, agent, or specialist to determine what strategy, if any, you should consider to ensure that your mortgage continues to align with your financial goals. Outside of mortgages, another group of individuals that would be influenced by these rate hikes are borrowers that have an existing balance on their home equity line of credit, or HELOC. So HELOCs are lines of credit that are secured against your home and are usually set up for as an investment tool or as a pot of money to borrow from for things like home improvement, some renovations, or even large purchases like car purchases. Like variable and adjustable mortgages, HELOCs are also based on the lender's prime rate, and they might either have a discount, like prime minus 0.15%, for example, or in most cases, a premium, so prime plus 1%. TransUnion, one of Canada's credit reporting agencies, so there's TransUnion and Equifax, estimated that at the end of 2021, the average HELOC balance in Canada was just shy of $150,000. So with an increase in prime by 0.25%, borrowers with that kind of balance on their HELOC could expect a monthly increase to their principal and interest repayment. So that means they're actively repaying over 25 years of just $19 a month. So you might be saying, okay, Jarek, this is great information. Like, what do I do? What's your suggestion? I'll say that every individual's financial picture and goals are going to be different. So before making any moves, definitely consult with your mortgage broker, your mortgage agent, or specialist to discuss any kind of options or strategies that are available to you. But at a high level, for most people in a variable and adjustable mortgage, it would be wise to stay the course and not lock into a fixed. Although, yes, there is an increase and you're still going to be paying a little bit more, you're still going to be below the equivalent fixed rate that you would have potentially signed on for at the beginning should you go the fixed route. So you're saving money. Now, in addition, don't forget that there is a difference in terms and penalty amounts if you were to break your mortgage, either now or in the future. So definitely consider that cost as well. However, if your budget is tight and you feel that you might run into financial difficulties with this rate increase, speak to your mortgage broker, agent, or specialist as soon as possible. You really need to figure out the options that are available to you. You want to get ahead of this before you either can't make your payments on time or at all. Not paying your mortgage is really, really going to affect your credit, so get ahead of it now. One other option that I hear a lot is people discussing this locking into the fix from a variable or an adjustable rate. So although this might be a good option for like a small group of individuals, staying the course is most likely going to be the better decision for those that have the funds available to weather through this and subsequent rate hikes. But again, no matter what you're considering, always speak to your broker, agent, specialist to figure out what options are available to you and kind of run scenarios to make sure that you're making a good decision. If you're in Ontario and you'd like to chat about your mortgage and real estate goals, I'm always happy to chat. With this Bank of Canada meeting in the books, the next meeting date for the bank is April 13th. So what do you think is going to happen in the next meeting? Do you think they're going to increase it again? And if so, by how much? Or do you think they're going to maintain a new rate? Drop me a comment in the comment section of what your prediction is going to be. I hope that you found this video beneficial. And if you haven't done so already, please subscribe so that you can continue to receive more videos on how to have your mortgage work for you. Thank you so much for watching. And as always, be great, do good, and build wealth.